Standard Bank has opened its books at the halfway stage. Headline earnings are up 4%, while return on equity came in at 18.5%. That's within the group's target range of 17 to 20%. CEO Sim Chabalala says the results were underpinned by strong organic growth. An interim dividend of R7.44 has been declared. That's up 8% on the previous period's payout. Looking ahead, Standard Bank expects inflation to continue to moderate, and this will provide scope for interest rate cuts. The firm has forecast a 25 basis point rate cut in September and November, and a further 50 basis points of cuts in the first half of next year. The group believes this, together with ongoing policy reform and improved business and consumer confidence, will support growth going forward. Exaro has had a difficult first half. The coal producer has posted a 37% slide in interim headline earnings per share. That's as a number of factors weighed. These include weak demand, lower coal prices, and increased costs. A dividend of R7.96 has been declared. That's a reduction of 30% when compared to the prior period's payout. Resilient REIT has upped its half-year dividend. It's declared a payout of just over 218 cents, which is nearly 8% higher than the prior period. The firm, which owns 27 retail centers, says its portfolio continues to remain defensive despite the challenging economic environment, and it's positive on the rest of the year. Resilience upped its distribution forecast for the year to 428 cents, but has cautioned that it's based on, amongst others, interest rates remaining unchanged and that there's no further deterioration in the macroeconomic environment. Stardo is eyeing a profit bump. The private education group expects headline earnings per share for the half year to be as much as 25% higher. More detail will be published when the firm opens its books on the 26th of August. Treasury's limited the Gauteng Health Department rollover allowance. It had failed to spend R1.1 billion in the 2023-24 year and had requested a rollover of R780 million. But Treasury is only allowing a rollover of R530 million. The rest will be returned to the fiscus. Over in the soft commodities scene, garlic is one of the most sought-after agri-commodities in the world. But in South Africa, almost all garlic produced is used only domestically. Why does SA not export garlic, or are export opportunities increasing?
Do we really need garlic? I mean, the point is, thousands of years ago, it was used to cleanse the environment from evil spirits. Because of its pungent smell, it was believed that if you really walked around with garlic in your house and you placed garlic, evil spirits wouldn't come in and try and take over your household. Of course, people learned from that, and for thousands of years now, it's been a key ingredient. It's not a necessary ingredient in life, but it's like love. If you don't have it, you start missing it. You don't realize it was in the sausage. You didn't realize it was in the canned tomato and onion that you put into your food. You didn't realize it was all around. So where does all this garlic come from? And how does South Africa fit into this global picture? And who are the big brothers and who are the people spoiling the party when it comes to garlic? And I bought this clove this morning for about just a couple of rand, not very expensive, but in its raw format, funnily enough, more expensive than the crushed garlic you get in those little cans in the supermarket, etc. But interestingly, as far as global production is concerned, we're going to put up a graph and show you what happens in global production. Here you can see that primarily in the northern hemisphere, garlic originated in Europe. It's one of the few global spices and foods that actually originated out of Europe and not Asia. But South Africa is shown there, but a very, very small percentage of garlic comes from South Africa, and we're going to show that in a next graph. But most of it comes from China. China produces more than 70% of the world's garlic. And the next big players, are countries like Spain, are countries like other countries in Europe or in Asia, Uzbekistan, that produce garlic in large numbers. China produces more than 21 or 22 at this stage billion or million tons of you can see in the market board we're trying to set up now. You can see that China produces more than 22 million tons of garlic, and the next player is India. Funny enough, you can see, so the rest together make about 30%. There's countries like India, Egypt, Spain, Ethiopia, Uzbekistan. So a lot of countries where there's a dry climate are producing garlic. And so why is it now that South Africa is becoming important? Well, some of the geopolitical changes in the world have started changing the way the supply chain of garlic around the world is affecting global markets. So countries like China and India are finding it more difficult to move their goods into Europe because of the issues in the Suez Canal and in the Red Sea. Because simply global supply companies like Maersk and all those are simply not finding it safe to take goods through that. So to quickly look at South Africa, we only produce about anything between 6 to 8 tons of garlic. The bulk of that is used locally in South Africa because it goes to market quite quickly. There you see the big bulk of garlic that goes out globally. Here, this is what it looks like. This is the classical sort of Egyptian pink. You get Egyptian pink, black, blue. But this grows very well in South Africa, but not really used as a main crop in South Africa. We see this crushed garlic in our supermarkets, garlic powder growing significantly. This is the production, global production, where 80% of the world's garlic goes into the big global production companies. And then you have sort of later sort of health goods, etc. But at the end of the day, the best thing we can say about garlic is, yeah, you might use it for all sorts of things, but it really is like love. Once you don't have it, it causes a stink in the rest of your life.
That was Business Day TV's Gary Alfonso. Further afield, China's factory output slowed for a month straight in July, showing the recovery. The world's second largest economy was losing steam, although the battered consumer sector perked up slightly as stimulus targeting households took effect. Let's take a look at this package report for more.
China's economic recovery has lost momentum according to official data. Mixed results out showed the world's second largest economy endured a patchy start to the second half of the year. Factory output slowed for a third straight month in July. Industrial output grew 5.1% from a year earlier, down slightly from June and below analyst forecasts. However, the country's battered consumer sector slightly improved as stimulus targeting households took effect. Retail sales were up 2.7% in July, higher than a 2% rise in June. It follows dismal export prices and bank lending indicators earlier this month. Some analysts argue data puts pressure on policymakers to roll out more support measures aimed at consumers instead of pouring funds into infrastructure. Chinese leaders last month signalled they would focus stimulus at consumers rather than infrastructure and manufacturing. The state planner said last month almost $21 billion raised through special debt issuance this year would subsidise a consumer goods trade-in programme. But a major slump in China's property sector has hurt consumer spending over the past 3 years. 70% of Chinese household wealth is held in real estate, so consumers have kept their wallets shut tight. There were few signs of things improving when separate data showed China's new home prices fell at the fastest pace in 9 years in July. Calls for more growth-boosting measures have followed officials ever since a widely expected post-pandemic recovery failed to appear 2 years ago. The government is still targeting growth of around 5% this year. But some analysts fear China may have entered a prolonged economic malaise similar to Japan's in the 1990s, and that bolder reforms may be needed to revive growth.